Latha, get from the micros back to the macros. While the US inflation data was hotter than expected, India's CPI, or consumer inflation print, has come in at a benign 4.3% for the month of January. But the industrial output for December has come in at 3.2%. To make sense of these numbers, Latha is now joining in. Latha.
It's a very big positive for the economy itself that the number January inflation has come in at 4.3% because we had touched 6.2 in October, then went to 5.5 in November, and then 5.2 in December. Now 4.3 is a very big come down from that 6% levels. Also, the goal for the monetary policy itself is around the 4% mark. So this justifies the rate cut that came. And it sows the seeds for another rate cut in April. At least that was the majority opinion, in fact, the unanimous opinion from economists. The number has been dragged down largely by food. Food inflation, which was 8.39 in December, has fallen to 6%. Even from year-ago levels, it's 8.3. So 6% is some kind of a 5-month low or a 6-month low on food, and dragged down largely by vegetables. Vegetable index fell 15% month-on-month, December to January, as did pulses. Pulses fell by about 2%. Those were the two items holding up the food inflation basket, and at least two big ones have come down. Core inflation, which is non-food, non-fuel, that's almost stationary at 3.7. It was 3.6 in December. It's remained under 4% for the better part. So the expectation is that, as we head towards April, you will have the February number, which is expected to be even lower than the Jan number, in which case a rate cut seems like in the bag for the market. But then we have the hotter than expected US inflation numbers. So it's possible the bond markets are not going to react today to these numbers because of the higher yields in the US. A quick word on the IIP number. That's a bit of a disappointment, 3.2. We don't give much importance to the number because it's a December number. All the corporate results have come out. So, we already know what is the level of output. In any case, 3.2 is a disappointment compared to the 4.4 previous month and 5.2 year ago. The positive was power. The letdown was manufacturing. Power was about 6.2, so that was a good number. Capital goods, that was excellent at 10.3. And that ties in with the government's capital expenditure in December, which was, about the best capital expenditure we saw the whole year. So that perhaps has aided that number. Consumer non-durables, FMCG goods, was the huge disappointment at minus 7.6.